Welcome to Section 3 of the ASC 470 Debt Accounting Training Series. In this section, we are going to look at three tightly connected topics: how debt issuance costs are treated on the balance sheet, how the carrying amount of debt changes over its life, and what actually belongs in interest expense on the income statement. These three topics form a single coherent picture of the true cost of borrowing. By the end of this section, you will be able to define what qualifies as a debt issuance cost and how it appears on the balance sheet. You will be able to apply the effective interest method to track how the carrying amount changes period by period. And you will be able to identify every component that belongs in interest expense, not just the cash coupon. These skills prevent some of the most common and consequential errors in debt accounting. Here is the key thing about debt issuance costs. They do not sit on the balance sheet as an asset the way many people expect. Under a ASC 470, they are presented as a direct deduction from the debt itself. Think of it like debt discount. It reduces what you show as the carrying amount of the liability. The only exception worth noting is revolving credit facilities, where presentation as a separate asset is still permitted. And remember, only external, third-party costs qualify. Your internal team's salaries while negotiating the loan, those get expensed immediately. The test is direct attributability to the specific debt instrument. If the cost would not exist but for this particular financing, it likely qualifies. Lender fees, legal work on the loan documents, underwriting commissions on a bond, all of these are directly tied to getting the debt done. But general advisory costs, broad legal retainers, or any internal staff time, those do not pass the test. The surprising part is how often companies try to capitalize internal costs because the team worked intensively on the deal. The standard is clear: only third-party external costs. Issuance costs do not sit static on the balance sheet. They amortize over the life of the debt. The required method is the effective interest method, which means the amortization amount is slightly different each period as the carrying amount changes. Here is why it matters. Every dollar of issuance cost that amortizes increases your interest expense in that period. So the income statement impact builds gradually, period by period, until at maturity the costs are fully absorbed. Straight line is only acceptable when it produces a materially similar result, which it often does for smaller amounts. Most people assume that when you make a cash interest payment, the loan balance goes down. Watch out for this one. That is not what happens. Cash interest payments reduce the interest payable liability, not the principal. The carrying amount of the debt changes for three reasons. It increases as discount amortizes and the balance accretes toward face value. It increases as interest accrues to the balance, and it decreases only when you actually repay principal. Understanding which transactions touch the carrying amount and which ones do not is essential to keeping your amortization schedule correct. Let us make this concrete with numbers. Imagine a bond with a face value of $1 million, a 6% coupon, but issued at only $950,000 because the market demanded a 7% yield. In year one, you apply the 7% effective rate to the $950,000 opening balance. That gives you $66,500 of interest expense. You only pay $60,000 in cash. The $6,500 difference accretes onto the carrying amount, bringing it to $956,500. Each year the balance grows a little more, until at the final year it reaches exactly $1 million. That is amortized cost in action. Here is a useful mental model. For a discount bond, the carrying amount starts below face value and climbs upward each period. For a premium bond, the carrying amount starts above face value and drifts downward each period. Both paths converge to the same destination, face value at maturity. The direction of travel tells you about the relationship between the coupon rate and the market rate. If the coupon is below the market rate, the bond priced at a discount and the balance accretes up. If the coupon is above market rate, it priced at a premium and the balance amortizes down. Simple, but important to keep straight. This is where things get interesting, and where errors happen most often. Interest expense on the income statement is not simply the cash coupon. It has three components for a typical discount bond: the cash interest you pay, the discount that amortizes each period, and the issuance costs that amortize each period. Add all three together, and you get the true economic cost of borrowing for that period. For a premium bond, the premium amortization acts as a credit, reducing interest expense below the cash paid. The total should always equal the effective interest rate multiplied by the opening carrying amount. Put the numbers together. Cash interest is $60,000. That is the check you write. Discount amortization adds $6,500. Issuance cost amortization adds another $3,000. Total interest expense, $69,500. If someone recorded only the cash payment as interest expense, they would understate it by nearly 16% in year one alone. The surprising part is how common this error is in practice, particularly when the issuance costs and discount are not large relative to the principal. Teams sometimes treat them as immaterial. They rarely are once you run the numbers. Most people assume interest expense equals cash out the door. That assumption is wrong under U.S. GAAP for any debt issued at a discount or premium, or with issuance costs, which is most real-world debt. The fix is simple once you know it. Always compute interest expense as the effective interest rate times the opening carrying amount. That single calculation gives you the correct total. Then you split it between the cash paid and the non-cash components that adjust the carrying amount. Get that discipline into your process, and you will never make this error again. Let us translate this into journal entries. When you accrue interest, you debit interest expense for the full effective interest amount and credit interest payable. When cash goes out, you debit interest payable and credit cash, only for the coupon amount. The difference between the two entries is the discount amortization, which naturally increases the carrying amount. Separately, you amortize issuance costs by debiting interest expense and crediting the contra liability. The balance sheet then shows face value, less unamortized discount, less unamortized issuance costs, netting down to the amortized cost carrying amount. Clean, consistent, and auditable. Here is the one exception worth knowing. For a revolving credit facility, the debt balance fluctuates constantly. You draw it down, repay it, draw again. Because there is no fixed outstanding principal at inception, a ASC 470 permits issuance costs to be presented as a deferred asset rather than a deduction from the liability. The amortization still happens over the commitment period, typically on a straight-line basis. Everything else we discussed still applies. It is purely a balance sheet presentation difference. If your organization has both term loans and revolvers, make sure you are applying the right presentation to each. Let us bring it all together. Debt issuance costs reduce the carrying amount of the debt on the balance sheet. They are not a separate asset. Only external costs qualify. Internal ones are expensed on day one. Once the debt is on your books, it is carried at amortized cost, and the carrying amount moves toward face value every period. Interest expense is never just the cash coupon. It always includes the non-cash amortization components. Master these three ideas, and you will handle the vast majority of debt accounting situations correctly. Thank you for completing this section on issuance costs, subsequent measurement, and interest expense. Thank you for watching. Subscribe for more training from PNJ Group.